Okay, everybody, we're going to go ahead and get started with Chapter 10, Preferred Stock, Consolidated Earnings Per Share. Apologize, I was having a little trouble getting this up earlier this week, but I'm really hoping that I can get this to you and you can catch up on that week 3 homework. All right, so we talk about preferred stock, consolidated EPS, consolidated income tax, and the objectives. We're going to look at the consolidation procedures for subsidiaries with preferred stock. Um, we're going to talk about basic and diluted earnings per share for a consolidated entity, and we're going to discuss accounting for income taxes for consolidated entities. All right, so just to recall preferred stock, it doesn't change the consolidation in principle or the calculations. Common stockholders' equity is equal to the total amount, total equity less preferred stock at book value, which makes sense. So I notice how they say common stockholders. It's kind of, you know, confusing because there's a lot that goes into equity, but equity is always broken up between common and preferred. So once you have the total equity, then all you have to do is subtract out the preferred to get the common stock, is what I'm trying to say. The income goes to the preferred stockholders before the common, and then it goes to the controlling interest, and then it goes to the NCI, the non-controlling interest. So in front of everybody, preferred stockholders, hence the term preferred, are first in line for payment. Subsidiary dividend payments must consider payments to preferred before stock before common. Again, when the dividends go out, preferred is first. Okay, so who holds it? Usually outsiders. In it kind of is a non-controlling interest, and it can be held. It can also be held by the parent. And then there's two ways you can do. You have to choose between doing constructive retirement and cost. Okay, so we're going to go through and review preferred stock. And if I was you and I was studying for the CPA, I would pull out my note cards and just take these items in and just review these things. Because one of the things is, this is one of those things where these are all CPA questions. So I would learn these definitions. So the idea of callable is the callable preferred stock means that they can call it up at any time, and basically the owners who issue the stock can call the stock in and say, okay, we want it back. We're going to give you the money for it. Um, Redeemable preferred stock basically it allows the issuer to buy the stock back at a certain price and retire it. Okay, so there's also different types of preferred stock. The other thing that you have is cumulative or non-cumulative. All right, so cumulative, basically, you come in and you have like a certain percentage listed on the preferred stock certificate every year, and you're supposed to, like, when the dividends are issued, you're supposed to pay out a portion of that dividend at that percentage that's listed. That's why they're supposed to get like a yearly rate for the dividends. But if the company has a bad year or chooses not to kick out dividends, then instead, unlike common stockholders who just get it when they get it, preferred can basically, with cumulative, they can say, well, I didn't get paid dividends in 2011. So not only will I get 2012 dividends, but I'll also get what I would have made in 2011 at that percentage rate. So, and then the rest goes out to common. Common usually gets the lion's share in the years that it is sent out, but they don't get that guaranteed if it's cumulative, and they don't get first in line for paid. So sometimes maybe after paying preferred stock, there's no dividends left. So participative and non-participative. So participative preferred stock is preferred stock that provides a specific dividend that is paid before any dividends are paid to common stock and takes precedence over common stock in the event of excuse me, in the event of a liquidation. Participated preferred stock participates, and this is quoting here, as converted to common stock basis with the common stock and the distribution of the remaining assets. So basically what happens is, basically, like I just explained, cumulative and non-cumulative, and how common basically gets whatever is left over. Well, usually, if it's a good year for dividends, preferred stock will get a little tiny portion of the dividends, and then preferred stock will get a little tiny portion, and then common will basically, here, let me just draw this up. This is the best way to do it. Okay, so the dividends come out, all right, and then you get you basically get preferred, and then you get common. There we go. And that's a D, in case you're wondering, that big old circle. That is a D. Okay, there we go. D. All right. I'm trying to make it look like a D. So the dividends coming out. Okay. So what happens is, with the participative, normally the dividends come out, the preferred gets their kicker, and then it moves on to common. Participative is allowed to participate with the common in that bigger share of the dividends if there's a big share coming out. Non-participative is no, they don't get any of it. They're just basically resident. So the definition is they typically receive an amount initial to the initial investment plus accrued and unpaid dividends upon a liquidation event. So versus non-participating is converted to common with the common stock and the distribution of remaining assets. So they get a little bit more on the participative. I hope I explained that in a way that wasn't completely confusing. Limited voting rights. Common gets to vote. Preferred has very little right. And then there's cumulative. Most of it is cumulative and non-participating. So that means that they get paid every year. They're a little percentage, but they don't participate with common and liquidation. All right, so the book value, I hope I've covered that enough. Go back and read these definitions. I think you'll really find it helpful in understanding what's going on. The book value of preferred stock is call or redemption price, par value if neither, plus the dividends in arrears if it's cumulative, that little percentage portion each year that they're supposed to get. The income allocated to preferred stock is current period dividend in respective of the amount declared if cumulative. All right, and if it's not cumulative, then there's no payback from prior years, and they just get whatever happens to be out that year if they choose to do it. So the preferred stock dividend is the face value of the certificate times the dividend rate, which is also on the certificate. Okay. All right, so here's an example. Okay, so here's preferred stock held by outsiders. Papa buys 90% of Sun for $3.96 when Sun's equity consists of 100 preferred, 200 common, 40 other paid in, and 160 retained earnings. The preferred stock is cumulative, non-participating, and carries a 10% dividend, and is callable at 105 with par value. There is no arrearage. In other words, there's no previous years that we should have been paid, but we weren't. During the year, Sun earns $50 and pays $30 in dividends. Okay, so let's get going. So first thing we're going to do with this calculation is the easy stuff. So I always like to start with the one thing I know. So the first thing we've got is we've got 90% of Sun for $3.96. Let's go ahead and get this one. Circle it for you right here. This one's right here. Easy stuff first. $3.96, 90% of Sun. Whoosh, right here. Okay. The next thing is the implied value. So many times we've done implied value. I would be absolutely crushed. I'll put it up again. 396 divided by 0.9. Boom. Oops. 396 divided by 0.9. Boom. 440. Okay. Implied value. Super easy. Okay. Now let's get to some of the other stuff. Okay. So the total equity. So the total equity is going to be two things. It's going to be the value of the common stock, okay, plus the preferred, plus the other paid in capital, plus the retained earnings, okay? That's all of it. So don't make it too hard. You know you've looked at a balance sheet before and seen total equity. You know what the calc is. So let's look at it here. So we got 100 for preferred plus 200, I'm hitting plus in between, common, plus 40 other paid in capital for 340, and then 160 for retained earnings. That's 500. Okay, so that's our total equity. Okay, book value of preferred stock. Okay, so now we have to subtract. We've got this part, done these, this one, we're here, 105. So the book value right down here, look at this, they made the calculation over here for you. They're so nice, look at that. Friendly, book value. So this gets subtracted off, and this gives us 395. Okay, so push this over here to this column, and then take the last little bit, 440 minus 395 equals 45. There you go. There's your goodwill. So these are all our calculations for preferred stock. Okay, so there's a couple things going on here, and I brought in some information from the problem. So the first thing I want to point out to is in the problem, they gave you the 10%. It would have been nice if they had just put 10% preferred. That way it would have been obvious that they were getting 10%. So like, just, you know, pointing out a little critique of the book. It just makes it a little more understandable. But the reason why you are multiplying 10% times 100 is it's 10% preferred. So like if you had a little stock sheet and it was preferred stock, it would have 10% on there as the dividend rate. It would look like this. It wouldn't actually look like this. It'd probably be a lot better looking than mine. But it would be a stock sheet with preferred stock and the 10% dividend amount given out. So that's why I thought this might be a little confusing for you. Okay, so usually in the problems it says it's 10% preferred or 6% preferred or whatever. And that's that kick out that they have the percentage of dividends that they get each month. So let's look at Sun's net income. Sun's net income is 50. All right, and they pay 30 in dividends. All right, so we've got that little tidbit, and that's from the problem. So we set up net income right over here to start with. We've got dividends, and we'll do those second. Okay, so the net income, you remember amortizations. Oh, thank goodness you don't have any. Don't want to be thinking about that in this chapter, right? And then here's the next part. So the person that gets to go first in this pecking order is preferred. So when you're doing your little boxes or whatnot, preferred goes first. Preferred goes first. They get a $10 preferred income from the dividend. All right, they get $10 of the net income too. So they get little treats. They get a nice little situation. Okay, so we take that out of both spots here. We take that out of the income right here, and then we take that out of the dividend. Both of them go to preferred. All right, so once you take out preferred's amount, you get $40 left over. All right. The other little tidbit out of this piece is you have to break, when you break to common, and that's who gets to go next. When you break out to common, common gets the $40 part, but you've got to break it between non-controlling and controlling interest. Now, one of the things that bothers me when we're doing this is it's confusing when they put NCI share preferred. Just get rid of that. That's confusing. It's preferred, whatever. They try to say it's a non-controlling. Yeah, it is a non-controlling interest, but just don't do that. It'll confuse you. So just scrape that part out on your notes. Just call it preferred. All right, so they break out between NCI and controlling interest share, and then everybody gets their portion of the income. Then the dividends, same thing. You take out the part for preferred, which we did earlier, and then the rest goes to common, broken out by percentage. Make sure that you give everything to the right share. So here's a little tidbit. 90%, when you have the rest of the common, they get 18, and they're supposed to get 46 36 in the income. All right, so that kind of kicks you out between the income and the dividends, and the common and preferred. Make sure that you kind of follow this a little bit. Scratch this out. It's confusing. Make sure you don't forget the 10% that goes to NCI. All right, and I'm going to pass through these worksheet entries, but you can see here the journal entries for non-controlling, the dividends. You've done these before, so I'm not going to do too hard on this. All right. If a parent uses constructive retirement, so a parent acquires a sub's preferred stock, invests in sub, the preferred stock is recorded per book value. So they're doing that constructive retirement. You've seen that before too. So any difference between the book value and the cost of the stock is an adjustment to paid-in capital, and there's no owner transaction or gain or loss. Okay, so if they do use to do that, there's no gain or loss. And then the investment is carried at book value of the preferred stock, and again, you increase for dividends and arrears, and then you take it out when the dividends are finally declared. All right, I'm going to let you read this about the cost basis. Okay, so let's look at this parent acquiring preferred stock. Pop owns 90% of Sun, acquired a fair value plus an implied value of 45. All right. Pop acquires 80% of Sun's outstanding preferred stock for 80. And then here's a little look at Sun's equity at the beginning of the year. So we've got some preferred stock. It is callable. And there's 1 year in arrears. So what's going on here is there's some stuff that's owed for previous years. So whatever percentage they had in there. Common stock, nice easy to deal with, 200. Other paid in, retained. And then here's our total equity. Remember that this right here, all these things added together is your total equity. If you can get one item out of this class, remember that. Okay, so I just want to bring in a couple of slides from previous slides just so we can kind of wrap our mind around what's going on here. So the first thing we look at is the book value of the preferred stock. So we're going to take the call price, and I didn't have room on the slide to bring this in, but you remember it from 2 slides back. It's our 105. Plus, on the problem, they said they had $10 in dividends that had not been paid. If you go back to that first page, it's way back there. All right, so we do that calculation to get 115. And then we're going to look at the book value of Sun's common stock. So remember 480 way back when, right? Some of these things I brought in from previous slides because I knew we'd forget. We're going to subtract out what we've just calculated, which is 115. And then we're going to look at the total value with goodwill. So our calculated total value is our total equity. And then we're going to add the goodwill in to get 525. So these are all our calculations. Now, the bottom part in the box is our final walk away. All right, the easy one I'll do first is our preferred stock. Okay, the next one is our investment in Sun. Now, we may not remember doing dividends because it's been a minute, but we actually paid dividends. So we had 440 to begin with in our implied value. Remember, way back when. Some of this stuff way back when is hard to track. And then we paid dividends of 30 way back when we were doing all those lines and breaking them down. All right, so then we take the 90% value of that. Here's our 369. And then we could go 2 different ways. We can either subtract the 410 from it to get 41, which is my easy way out. That's positive, by the way. Or we can simply just take 410 times 0.1 and get 41. All right, and then so we've got these two and our non-controlling interest. Okay, so let's look at this Pop preferred by acquisition of preferred stock. So they acquire 80% and pay $80 for this. And we're going to revisit this constructive retirement. Hopefully you all are with this from that previous chapter, or they can use the cost basis. And so the cost is 115, which we figured on the previous slide, and we would just take 80% of that to get 92. However, we paid $80, so they have a $12 difference, and then that goes into other paid in capital for the constructive retirement method. All right, so here is 2017 income and dividends. Again, this is allocated to preferred first, and you break it down 80-20 from controlling and non-controlling interest. All right, stop. Remember that the common, their breakdown was 90-10. Remember, this is just new stuff. It's okay if they buy 80%, 80-20 on preferred, and then common is a different ownership amount. That's totally okay, because it's totally two different types of stocks. Because I know that, like, in the past, people get confused here, and they're like, well, wasn't that 90-10? And then it switched to 80-20. Well, it was only 80-20 for the preferred stock. Okay, so now let's look at the journal entries. Again, just pretty simple. You can see here where we added $12 into other paid in capital. You can see here where the dividends increase the investment, and then also increase the investment in the preferred. So that's just a simple breakdown of the constructive retirement entries. All right, once again, you can kind of see the breakdown and how we got to the final investment in Sun and non-controlling interest using the journal entries right here. And from the previous, also you can see here where we had the preferred and retained, crediting the investment, and then crediting the portion of non-controlling interest. Remember that this right here, this 92 is at the actual book value basis, and it's at 80%. So don't get lost and mix up your 80-20 with your 90-10. Super easy to do. Best to just keep a little post-it note there, kind of keep it. The other thing I tell people is just like start thinking of preferred stock as like that third interest. I don't like to call it non-controlling. It gets very confusing when you do that, but it's good to think of it as another spectrum of your breakdown. All right, and I'm going to let you look over these journal entries. Pretty simple, nothing new here. All right, with cost basis. All right, so the same thing happens if you use constructive retirement and cost basis. All roads lead to the same destination there. The only thing is the investment is either at book value or cost, and then the other thing is it all goes into paid in capital. Constructive retirement does it at acquisition. Cost basis does it as part of the consolidation process. All right, so here comes my favorite thing, earnings per share. All right, so EPS, earnings per share, you have two types of earnings per share. One of them is your basic earnings per share, which is basically your earnings per each common stock share that is outstanding. All right. And one thing I want to say before we hop on this is remember that if you have a bunch of shares, your EPS is going to go down. So it could be like a couple pennies per share. If you have only a few shares outstanding, then it's going to be a little bit higher. So a lot of times when you're doing earnings per share, don't look at the dollar amount, look at like the number of shares outstanding and use that to inform your decisioning on whether or not you would purchase the stock. All right, anyway, GAAP requires you to report both basic and diluted where applicable. And a lot of it is decided by the capital structure. So some potentially dilutive securities, and we'll look at that definition here in a minute, can be converted into subsidiary common stock, and subsidiary potentially dilutive securities can be converted into the parent's main common stock. Okay, so let's review the basic calculus for EPS. All right, and so when I started looking at this calc, this is just the 90s talking. I thought that we included other comprehensive income, which is the operations outside. And what I looked up is most people list out separately continuing operations and discontinued operations, are things that are not necessarily related to operating income. So that's something that, like, if you're reviewing a financial statement, a lot of people list their EPS differently. All that you have to do with GAAP is disclose. So I would suggest maybe if you see the EPS, go to the notes, the financial statements, and double check that. So the numerator, there's a numerator. The top part is your net income minus your preferred stock dividends. So preferred stock is always outside of the EPS. Just a little side note. So preferred EPS is common. All right, and then you take the denominator, which is the weighted average shares of common stock. All right, and then that's your earnings per share. So net income divided by common stock and all the other junk taken out, except for comprehensive, which could be listed next to regular. I think I covered that. Okay, so diluted. So diluted EPS. Diluted EPS is the net income minus the preferred stock dividends, different. All right. Plus adjustments for dilutive securities. All right. And the denominator is the weighted average shares plus shares represented by dilutive securities. All right. So dilutive securities reduce the earnings per share. Non-diluted securities are excluded. Now, we've been saying the word dilutive security. What are dilutive securities? All right. Dilutive securities are stock options, warrants, convertible bonds, and they increase and they would increase the number of common shares outstanding if they were exercised. So all those people that get stock options as compensation instead of getting paid regular money, that particular group of people, and I would say probably people that are in positions of authority, because they get paid in stock, they can exercise that at any point if they have a certain type, like a certain type of option. Also, warrants and convertible bonds that can be converted into common stock, they aren't being used right now, but they represent the ability to reduce or dilute the earnings per share when they are used. So the best way to describe this is if you're making like a glass of iced tea and you like your tea a little strong. However, you've got like you want your glass of iced tea to be a little colder, so you want to add something, but you're not going to put it in right away. Maybe you let it steep, but at any time you could start adding ice to the iced tea. The ice being representative of things that are there but not being used, like warrants, convertibles, options. But when you add them into the process, your tea will become weaker, your EPS will go down. Hopefully that gives you kind of a thought of how this works. Okay, so what happens when all these potential dilutive items are exercised? So what happens is for bonds convertible into common, the numerator is the after-tax interest expense. The denominator is the common shares that the bonds represent. For preferred convertible into common, the numerator is the preferred stock dividend, and the denominator is the common shares that the preferred stocks represent. And then for the warrants, there's no numerator. These are tough, by the way. Warrants are tough to like wrap around, but you can do it. Denominator, you use the treasury stock method to compute the shares only if they're positive and dilutive. Okay, so that was a lot. All right, so here we are. If we have a subsidiary whose convertible securities convert into common stock. So the first thing you do is you compare the parent's equity, and so you'll take the realized and the dilutive earnings. If the diluted is higher, then you skip to non-dilutive. And so I think before we go reading all this out, I think what we need to roll out of this is there's stuff out there that's not necessarily getting exercised, but it can be exercised. And so by disclosing that dilutive, basically what you're doing is you're alerting the people outside of the company that their EPS could be dropped or diluted by these items being exercised. And so that's how you need to frame all these calculations and decision makings is, how do I disclose this in the most disclosed, most transparent way? All right, so if you have diluted earnings, you take the EPS once you figured it out and divide it by the shares of the parent. The parent's diluted EPS, the numerator is reduced by the difference, excuse me, and the denominator has no effect on the parent shares. Okay, so here's an example of preferred stock convertible into subsidiary common stock. All right, so the son has net income $50 and $20 weighted average shares of common stock. And you know what's really fun is when that weighted average is already figured for you, that's just like a gift. So go ahead and enjoy it. So the preferred had a $10 dividend and is convertible into 12 shares of son's common. So what's basically happening right now is you could take that preferred out at any time and go make a claim against common. And that's basically what that is. So you could look at the basic earnings per share, right? So the basic EPS, you take that net income and subtract that $10 dividend, and then divide it by the weighted average shares. Super simple. That's what we're used to looking at. But because we have that preferred to common claim out there, we're going to do a little bit more work. We're going to subtract out the dividend, then we're going to add a few things back, and also we're going to show where we have that claim to convert right here. Okay, so let's go back and look at this calculation for the parent's basic earnings per share. So we have son owned 90% by Pop. Separate income is 150. Pop has 200 shares of common outstanding all year and no dilutive securities. Okay, so let's look at the separate income for Pop. It was 150. The income from son from the previous slide that I pulled up here at the top, remember, son had $50 net income, all right, minus that $10 dividend from preferred. So, and we do that at 90%, which is the parent's ownership amount. All right, add these together, and then we're going to divide it by 200, which is the total amount of outstanding shares. And just for reference, I threw the formula down here in the bottom left-hand corner. So again, this is a really basic EPS. There's no dilutive securities. This is a simple calculation, a super friendly one. This is what we love to see when we're trying to have to do the math ourselves. Okay, so here comes the diluted EPS. And the thing that I want you to get out of this is half the time we're doing add backs, it's usually something that we've subtracted out, particularly when we're looking at PS, preferred stock dividends. So don't get tripped up by the add backs. Just take everything kind of separately. It's not too hard to do diluted. I think the hardest thing about diluted is understanding what diluted is and how it frames the earnings per share. I remember for years when I was a student, I would pull out that financial statement, I would get to the bottom and I'd be like, what is this stuff? There's regular earnings per share and diluted. What is this diluted business? And it wasn't until I went to graduate school that I finally understood the difference. So a lot of times we just see it, but we really don't know what we're looking at. One of the beauty items in this class is you'll never ever look at a financial statement and not be able to fully understand what you're looking at. So I hope you get that from my class. All right, so moving on. So Pop's realized income from Sun. Let's start there. Remember that we took the 50 minus 10. That's the easiest. Remember 50 minus 10 was 40. 50 net, 10 dividend, right? 90%, 36, all on the previous page. The diluted share of Sun's, or Pop's share of Sun's diluted earnings, all right? So we have 20 weighted average common shares. So we're going to multiply that common share right here, by the 90% ownership times the 1.5625 to get 20, and that's $28.12.125. All right. So now that we see that the diluted earnings is lower, we will reduce the denominator by the difference. So first you have to run a test and see if it's lower or not. If it's lower, then you reduce the denominator amount. If it's higher, then don't. I guess don't worry about it. All right, so now we take the 186 minus the 36. Then we add back this little piece, remember, and then divide it by 200, which I didn't bring in that share of the problem, but that's the weighted average common.